So discussing farmland specifically, and its investment performance has been about 11.5 or a little over 11.5% since it's really being tracked in the 1990s. So this is a very good thing. Note that these are all positive returns. Again, you have a combination of income from the farmer paying you rent and the land appreciating in value that build up to these positive returns each year. So that's why it's been so consistently positive for so long. Now, again, 11.5% return, that's unlevered, that's not using debt to amplify it. So we think that is an incredibly impressive number. If we look at the S&P, so the green lines here are the same lines you just saw in the previous chart. So the green lines are the same lines, and we've just stacked the S&P next to it. Similar annual return, just slightly lower at 11.1% of total return over the last almost 30 years. But as you can see, it whips back and forth in huge directions. And again, so we're clear, we're not arguing that people should pull out of equities, especially today. Equities make up the majority of most investors' portfolios. And I think farmland is a good way to augment that instability in those markets, and with some consistent performance. And again, what's fascinating, we'll talk about correlation a little later, meaning the influence that one asset has on the other. As you can probably spot here visually, farmland does not appear to have an impact on the S&P. It's probably obvious, but interestingly, the S&P has statistically almost exactly zero impact on farmland returns. The consistency of farmland is not thrown up or down by moves in the larger stock markets. Farmland versus gold. This one is also pretty interesting. I think it's a pretty strong case against gold. Over the long term, gold does not provide you dividends. It is seen as a hedge in times of economic uncertainty and volatility. But remember, it's about compounding, not timing. And with gold investing, you got to be really good at timing. With farmland investing, we're not there. And the thing that people often buy gold for is inflation protection. And the statistics for farmland, we have an article written in Forbes about this that we refer you to. Farmland is almost as correlated, or not correlated, follows inflation as much as gold does. So it provides you that a similar type of protection. Plus, you get a yield. Looking at farmland versus commercial real estate. Again, 8.3%, nothing to shake a stick at. But this is quite a bit more volatility in commercial real estate. And these assets offer short, flexible leases that allows for renegotiation of fair rent and leases as market conditions change. And a few months of lost rent can place a property in default and lead to 100% losses for those equity investors in that commercial real estate. We are seeing that today. We're seeing massive rent abatements and forgiveness programs, and there's a lot of uncertainty in the world of commercial real estate today. Farmland provides a partial shield from that uncertainty, as most of the cash rents are paid up front or in bi-yearly annual installments, and we have exceptionally low vacancy rates. As far back as I can remember in farming or being in a farming family, I can't remember a single year where we did not have a tenant where we wanted one or where we had a default. So it's just it's far more boring, but it's a very different asset class than what most of us are used to with commercial real estate. Summarizing all of this, it's a chart that many of you have likely seen on our website. Is when we plot the annual growth rate, so that 11.5% annual return against the volatility, meaning how much does the asset whipsaw up and down in value, this is where farmland really stands out as something that's really interesting. You can get similar returns way over on the right with the S&P and with REITs, but you have to be willing to accept a far greater amount of volatility.